Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Thursday, September 12th, 2024. It is 1:21 p.m. Eastern Time as I'm starting the video. I'm going to do this one somewhat in reverse. I usually cover the equity markets up front, and I get talking about that, and then everything else kind of gets crammed down in the end and or left out if I forget it. So I'm going to start out here because I had two requests today on TLT, the Treasury bonds, ZB. One was for the price targets on TLT. I had given you the targets on ZB today and some new targets on ZB. But and mention if you want TLT, let me know. Somebody did reply. And then I recalled that I actually shared the chart yesterday, and this is it again. This is the live chart. Yesterday in the comments section, I believe it was, or maybe even in the video that I did, or both, shared these targets here, arrow breaks at the level. So to recap, yesterday, when shortly after I posted the idea, we did have the breakdown, and the breakdown's pretty solid now. We're well below it. You look closely, it was pretty much a breakdown in a back test yesterday, and the rejection that I like to see. The problem with a back test is you can keep back testing for a while, or you can go back up. So it's nice to see the rejection, that it just helps to firm it up. So and these are that's I would call this the first support level, not really price target. It's so small. I wouldn't be wanting to take profits on a 0.5% drop. But once we get down through there, that should open the door. You can see this is the first target there, 99.20. Remember, Treasury bonds, as I said yesterday, and I often repeat, are inherently low volatility. So you take a much larger, at least a double-sized position than you would on the S&P 500 to account for the below-average gain-loss potential. And then that just puts it back to a regular trade. So, in other words, first target at 1.35%. A 2 or 3 time positions can make that 3-4%, whatever equivalent trade on SPY or something. And so as of now, it remains, and this is what I gave yesterday, zigzag or way down, but here's a trend line I could easily see us coming back to. And that's going to be a drop if and when hit from the breakdown point. Again, with about that night, it should probably come in here somewhere about 95 or 94. And that's going to be about a 6%, we'll call it about a 6% drop right there if hit. So roughly a 12+% profit on a swing trade if hit. Stops will be commensurate to one's price target, meaning if you're only looking for a quick pullback, you want a tight stop. If you're looking for a 6% drop, you can give yourself a 2 or 3% stop loss. All right, and then on the other question put to me was longer term. My longer term outlook on treasuries, I'm more than glad to share that. I'm going to just say that that's a sort of a fluid outlook. I'm not rigid on that. There is, even in the near term, there's a lot of manipulation, more than, I believe, more than any other point in history, due to both the Fed, ever since the financial crisis, where the Fed started quantitative easing, purchasing, bond, intervening in the bond market, even direct intervention when COVID hit, buying even junk bond ETFs and things like that, invoking emergency charter powers that they couldn't do it. So we've just had a heavy hand, and also the Treasury, who issues the Treasury bonds. Yellen's been tweaking things to because of the higher interest rates in the longer term bonds, doing a lot of issuance in the short term. So now, with that being said, what I'm trying to say is longer term. I'm going to give you my thoughts. This is short term. This is just a 60-minute. I flipped over to TNX, which is the yield on the 10-year bond. You can do TYX. I'll show you both for the 30. You can see the positive divergence. So this is just TLT upside down. So this means yields go up. If you're new to investing, you might say, Randy, you're crazy. The Fed's going to cut rates on Tuesday or Wednesday, next Wednesday. Well, number one, a Fed rate cut is 100% priced in at this point in time. It's an absolute, is about as certain as it ever gets in the financial markets, as close to 100% certainty as you can give, that they're going to at least do a quarter-point rate cut, right? And there's talks they could even do 50. So, the rate cut's been priced in, and more importantly, the Fed doesn't cut or raise or control any rates on long-term bonds. These are set by market forces. The Fed controls the overnight lending rate. That's called the federal funds rate. All right, so that's an overnight, as short-term as you get rate. And so again, one doesn't necessarily have anything to do with the other. Anyway, that's what it looks like here in the very near term. There's that uptrend line right there, a downtrend line you could target. But let me just step back. Let me just go to the longest term real quick and go here. Let's just go to the 30-year bond. Okay, this is something I've covered many times in the past, but not I don't do it on a very regular basis because it's very, very long-term stuff. It's not going to determine how you're positioned today, tomorrow, but it might formulate your longer-term outlook. It definitely does mine. So this is the 30-year Treasury bond yield. We can go all the way back into the mid-70s here. That's what we're looking at right here. And this is a monthly chart, meaning every candlestick is 1 month of trading, 1 month period. And this was we were in, if those of you that really, are really well versed in, financial history, we experienced the last bout of severe recession in this country was in the 70s. And we had runaway inflation that's peaked in the early 80s. Think Carter leaving office, Reagan coming in, and that's when we peaked there. We had high 16-18% mortgage rates, government bonds, and everything else was paying the crazy high rates, and that was it. So that was an inflection point. We ended a period of rising bull trend in interest rates, rising interest rates, and we embarked on a new would be defined as a secular bear market in interest rates. Okay, bearish trend. And let me just say this now, and I get talking about, because this warrants, this is important to the economy, to the long-term outlook of the market. So I may just truncate the video after covering bonds and do the stock market in the next one, and commodities, everything else. But let me go on. So Economics 101, if you've taken a basic economics course in college or maybe even high school, you know that falling interest rates are bullish for the stock market and bullish for the economy. It lowers the cost of capital, number one, which spurs economic growth. When interest rates are 8% and all of a sudden they drop down to 4%, it's that much more cost advantageous to open a new factory, expand a plant, hire employees, start a business, etc. Go, buy a home, all of it. So that's an immutable fact. Over time, that higher rates are constrictive to economic growth, lower rates are more conducive. Right? Simple stuff. It's not a very hard concept to swallow. And the other part of that is to the stock market is that high rates equate a safe return, an alternative to stocks. Because back here, you could get, 15%, 100% guaranteed on a risk-free investment, a US Treasury bond. You could lock in 15% for 30 years. Smart folks did back at that time. I remember as a rookie broker in the early 90s at Merrill Lynch, I had clients coming in, some of these older, I call them, the widows and, old folks coming in with, I saw those 15% coupon treasuries. I was shocked. Back then we were like 7% on the CDs and the, current rates at the time, mortgages, and some of those were coming due. So it was a real thing, believe it or not. Anyways, what would you give right now for that? So the point where I'm going with this is bonds interest rates in general are a competition to the stock market. Bernanke himself came out and said that back during the financial crisis. One of the reasons they took rates down to zero, and he didn't mix words, was to drive money into the stock market, to support the stock market. And this is back here. This is when the whole rounds of quantitative easing started. You can see we had a regular, very controlled, well-defined price channel, a downward bear market, as any trend works. There's rallies, and we call these secular bull and bear markets within cyclical bull and bear markets, or bull and bear trends within the larger secular trend. And then we had something unseen, at least in modern history, just these bouts. That was the first bout of quantitative easing and then we had several bouts thereafter. And then this is when the Fed hit the all-out nuclear button. Both the Fed, the Treasury, fiscal and monetary stimulus from both the federal government and the Fed. And so you can see it's almost abnormal. But either way, again, that's where you have unnatural forces. These were, if you want to call them, for lack of a better word, natural market forces of falling interest rates, right? And if there's anybody out there that for any reason may be confused, please don't be confused that we are coming off. And this is why I can see, a bear market that very few can envision right now. And it's called recency bias. I mean, again, going back, a lot of the folks that were investing in the stock market back here are gone now. They're dead. Those that sat through the bear market, the prolonged and extended bear market in the mid to early, really from late 60s, 68 to the mid 70s, vicious bear market. Those that went through the Great Depression, the crash of 29 and the ensuing, period after that, most of them are gone. They're out of the market. So most people only know falling rates and know a super bull market. You can just impose that a chart property is go and look at the S&P 500. I need to change this to, because SPY wasn't even around back then. So we have to go to the SPX, the S&P to compare because there was no SPY. There were no ETFs back in the 70s. SPX. Let's try this one more time. Okay, and I don't know why it won't cooperate. 1 second. I got it. There it is. Now keep in mind, when I talk about this, big bad bear coming down the road at some point, we're going back decades here. So that's not an immediate, it doesn't have to happen. It's something I'm on the lookout for, something that invariably will happen. And again, just want to show you, make no mistake about it, that this great super secular bull market that we've been in for decades now, that we've had cyclical bear markets. It doesn't look like much. There's the dot-com bubble back there. This is when the NASDAQ fell 78% after the peak in 2000. So they look like little blurbs there, but that was due to rising rates, of course. And then we had rates continue to fall, new bear market from 03 to 07. Then the great financial crisis that ended back there, and then with quantitative easing, 56% drop in both the S&P and the NASDAQ. And then again, this is when all the free money started. This is when they took it down and pretty much have kept rates at zero or near zero since then, just igniting the final really stage of this great secular bull market right there. Okay, so that is what's happened. Now let me turn off. So you again, make no mistake about it. The falling rates have been bullish. And let me turn off the comparison here. And now let me just speak again to rates only. So the downtrend line, the price channel, and you have the same thing with TNX, very well defined. Again, this is what I call a beautiful trend line. I speak, charts, to me, they're like art. Some you might be a big art fan and look at a Renoir or a friggin' any fancy painting there, and you find it beautiful. I find charts beautiful when I see a well-defined trend line like that. And even on the downtrend line, the channel was very clear. And then you can see those kind of irregularities and extreme, intervention that did that. So bottom line, they took the rates down to the floor there, and there was nowhere else to go. But what I can say has happened since then is by every single metric in technical analysis, both the breaking out of solid, and we don't have to squint to see it. This is when we broke above the secular downtrend line. And so that would indicate that a new bull market is underway in interest rates, meaning rising rates. Additionally, when you look at what makes a trend is defined as a series of an uptrend is defined as higher highs and higher lows, and that's exactly what we have so far, right? And more importantly, to say that we've started a new trend, that's also evidenced by taking out the previous reaction highs. You take one out, then another, and then another, and then you took another. So we've pretty much on this trend, we've taken out all the highs going back into pretty much back to the dot-com era right there. So one can't really argue now that maybe that's it. Maybe this is a trend and it's over. I'm giving you my longer term outlook. All I can tell you definitively is that it appears to me that we've entered a new period of rising interest rates, but again, the span I'm talking is measured in years and decades, not today, tomorrow, next week. All I can tell you is right now, and this is something, again, these are things I've covered in the past. We had a clean uptrend line. I highlighted back here, and we capitalized on it via trading bonds. We had a bearish rising wedge. We had negative divergence, rarely ever seen on the monthly chart, but when you get it, it's great. And we broke down. And this is the support level we've hit. So in a nutshell, I can tell you we're at support now. One scenario that I could see playing out, and I probably would say I have almost equal odds, I'd give it, is that we hold here and we go in and we put in another, and again, it's just based on my kind of intuitive feel, gut read, experience feel on how these indicators look, what's going on, that we come in soon, and it would have to be soon. We're at support. You have the 20-month moving average. You have some support here pretty good around, it's around roughly 4%. That's where the 30-year is right now. You can see this is the yield here. You just move the decimal over. It says 40.13. That's 4%. So that would entail another thrust up here in long-term rates. It would also be, I got to be careful. I'm just going to use the word catastrophic. It would be, let's just say bearish. All right, let's not try to use any dramatic terms here. That would be quite bearish for the stock market, right? Especially if we took out these previous highs, and it would mesh with my intermediate to longer term outlook. Those price targets I've given you since June on the S&P 500 and the Nasdaq 100, and so that is my preferred scenario right there. However, rates, remember, there's a thing, and a lot of people have written it off. It's called the lag effect. These rising rates, remember, there was so much liquidity, money printed, fake money out of thin air, printed by the Fed and all the central banks, injected into the economy when COVID hit, and that money is still sloshing around the financial system. So that's one reason there's been an offset to this rise in rates. And the other reason is it's just been a return to normalcy. Again, remember, here we are right now today, where we're at on the 30-year. We're right at where we were back in 2014. You can see the year breaks down here. Back where we were all around here, back where we were in 2008, back where we were back in 2003. So again, these rising rates, as you hear it on TV, the biggest rate hikes in nearly half a century, blah, blah, blah. They've just taken it back to a normal monetary policy. But what would happen is if we start going up, that is going to have an impact, all right? And what's going to cause that? The Fed's not going to do that, not willingly. That will be by forces out of their control, just like the runaway inflation that we had in the last couple of years that caused interest rates to go up this high. Okay, so that's it. All I can tell you right now, we're at support right now, and this is a long-term chart. That is a scenario that I think is very, quite likely. I'm not going to say very likely. I can also, the other scenario, and you don't want to hear it, it's not wishy-washy to me because I'm not trading off the monthly chart. I'm keeping an eye on it to formulate the bigger picture. But if we come down here much, break this support level, and these divergences play out, we don't go on to make a bigger divergent high first, we could come all the way back and back test that. Here's the thing, guys. That would be, and I'm doing my little air quotes, net bullish for the stock market. But there's a big caveat in there, or an asterisk. And I've said this before. To see rates fall like that, if the stock market's holding up, if the job market's holding up, the economy is holding up, then yeah, that's going to spur economic growth. It's going to drive more money into stocks because people, institutions and individuals aren't getting their 5.5 on their money market anymore. It's going to be net bullish. However, if this happens as a flight to safety because the stock market is going down and making new lows and down 20, then 30, and then 40%. That is not bullish. And that is what you get when the stock market drops, because two things happen. Number one, you get a flight to safety, and that's largely driven by institutions. Think pension funds, mutual funds, hedge funds. They sell high-risk stocks that are falling and going to fall more, and they put their money into safe treasury bonds to protect, shore up, the assets. That's a flight to safety. When you buy a bond, the price goes, if more buying at any point in time drives the price of the bond up and drives the yields down. Yields and prices of bonds it's an immutable inverse correlation. There's no variance there on treasury bonds. And when prices go up, yields go down. The other thing that could drive yields down like this and come in for a back test, which again, by the way, guys, would only be, it'd still be absolutely 100%, keep the uptrend intact, the breakout. It would simply be a back test, and then to see we most likely get a rally off that reversal off the primary secular bear market downtrend line. Because remember, we blew out above it. We had a little back test when we first took it out, but this would be the first back test. By the way, that's going to take years. Just where the arrows are drawn, if it went to that fashion, you can see my pop-up box. That's September 30th, 2025. So that's a year from now to get a full back. Again, if it came in there, I'm just kind of rough predicting where a back test could occur. And the other thing that could do that, besides a flight to safety bid, is a recession, which will then dampen future growth expectations. When the stock market, and remember, the bond market's a lot smarter than the stock market, and that's where the smartest of smart money lives, and it's often more correct than the stock market at predicting big moves. If the bond market sees slower economic growth, especially recession, that implies lower inflation and also lower economic growth, and that brings rates down. Okay, so there's your kind of 101 crash course on treasury bonds, both from a fundamental perspective, as I just explained why rates might go down, the two things that could bring treasury interest rates down, either a flight to safety bid or declining economic expectations. However, like I said, just looking at this and looking at the fact, as you've heard me say it once, you've heard me say it 1,000 times, support is support until unless broken. This is a line I created back in 2016. It's a very obvious and key support level, and that's where we're at right now. So there it is. I know that's long-winded, but somebody asked me for my long-term outlook on treasuries, and am I going to trade, am I going to short treasury bonds here, expecting that bounce and stay short? No, but I shorted the treasuries yesterday based on what I showed you on ZB and TLT, and that's the short-term stuff. And so as the short-term charts play out, let's just say for kicks and giggles, my final near-term swing targets hit. That's going to take us down here to TLT, which also would take us, up in interest rates and on TYX, right? And so then what that will do, so we rally on TYX. Here's the 30-year yield. Here's a trend line there. Let's just say we go up here and we rally. That's a good target, about 43.67. That would be a pretty nice increase in the yield on the 30-year. But if we get there, then what's going to happen is this monthly chart, you're going to see an uptick, and it's going to be more than just a little blip. We're going to see a successful defense of this support level and a reversal reaction off there. Okay, and likewise, we do this. I'm not going to be long or short treasury bonds anymore because I'll be stopped out based on this chart right here in the shorter term charts. Like I said earlier in the video, right now I'm just kind of eyeing up, about a 7% drop in treasury bonds, the 30-year bond, and that. So, if we go much above 2%, I'll probably even keep a tighter stop because I'm feeling this is a good entry here. But 2 to 3%, I think, is a maximum stop right now for that near-term target. And so that's it. So if it does that, boom, I'm out. Let it go. Move on to the next one. I'm going to take the time to extend this into currencies because there's another question put to me. Randy, can you talk about the rallying gold today? Absolutely. And so I did reply to the comment section, but I'm going to cover it here. So if you recall, you recall a lot. I cover the euro all the time. And it just trades so well with the technicals. And I've highlighted just about all these turns recently as both trading ops. If you're a Forex trader, you go long. This is the euro rising against the dollar. This is euro falling against the dollar. So you either go long euro or short the dollar, or trade the Forex pair. And that's it. Divergent low, rally. Divergent high, here, let me draw it out. Divergent low, rally, divergent high, correction. And again, it's not diverging. You don't just sell divergence. You don't buy positive divergence. You don't sell negative divergence. You buy trend line breakouts. So there, for example, we had a divergent low, and there was your breakout. And it wasn't just a little meager breakout. It was an explosive breakout. Rallied up here, put on a little divergent high, you had a correction. And then you rallied up, you started finding support on this trend line, you put in an even bigger divergent high, and then recently I highlighted that, and then we broke down, put in divergent low 1 here. This is divergent low 2. That means it's simply an extension of the previous divergence. And this, make no mistake about it, why gold's rallying today, the ECB just cut rates today for the second time in the last 2 months. So they're ahead of the Fed. Remember, the Fed will cut next week, but they haven't cut yet. And so you're seeing that little in gold, as I've covered many times with you, gold tends to move positively correlated with EUR/USD because this is the dollar in reverse. And simply when the dollar falls, it takes more dollars to buy an ounce of gold. And when the dollar rises, it takes fewer dollars to buy an ounce of gold. So that's why if you freeze supply and demand, gold will go up and down inversely with the US dollar, or positively correlated with the euro, which is, of course, the largest by far component of the dollar index at a 57.6% weighting, I believe. I've got it written down somewhere here. Yep, 57.6% weighting. So that's that. That's what's happening today. JPY USD, that one, it's kind of holding here, but it's still below the trend line. Remember, this was, what the media blamed is the big 16% drop we just had off the highs in the NASDAQ 100, which we milked down to the penny, reverse at the bottom. They assigned the cause being the yen carry trade unwind. And I won't argue that didn't happen during that. It was technically induced. There was a beautiful bearish rising wedge, divergent high. There was your sell signal. So it's not something that came randomly out of nowhere. It was priced in clearly. There's a beautiful uptrend line. Again, just look how many reactions, and boom. Now, in this trend line, it's beautiful too. I know I keep using that same word, but it's super well defined, and we cracked it. It's been a non-event so far, but it's more of we're kind of in spitting distance. We're right here. We're just a hair below it now. You've got positive divergence. Now, divergence is not a buy signal. What would be a buy signal is if you get back above the trend line. And then if you regain 146.558 right there, right? That would give you a rally in the dollar, drop in the yen, or we get rejected here. So I'm watching this, and I would encourage you to watch it. If we get rejected, can't get back above the trend line, we'll fall to this next support level, target zone down here. At that point, we may still have divergence, which could set the stage for a rally, or they burn through divergence. So when I get to the equity markets, which I'll probably do in the next video, I'm gonna show you some of those things that tends to happen in a bear trend. You get positive divergences, you get these nice looking setups, and they either don't play out at all, they fail to materialize, or you break out, and then and then the breakout, just as soon as it starts to look good, it fails. So all I can tell you as of now, keep an eye on it. It's just going nowhere for the last few days. It's still just below that primary uptrend line, but that should be, especially if we break that level, that's going to be net bearish for the pair right there. And you can see on a weekly chart, and this is another thing, you want to increase your odds to or decrease the odds of getting caught taking a whipsaw, a breakdown. Use a weekly chart and wait for a weekly candle close. Right now, again, it's the same trend line, but you can see it. That one you had to squint to see if you broke last week. Technically, you were a hair below it the way I have it drawn, but not enough to say, oh yeah, that's definitely a breakdown in the below the trend line. This week we're below it so far, but we'll see what happens tomorrow. And then on this weekly chart, I do have support. It's probably where I have it on the daily. Right here is the first support. Little minor support here, but this is where, based on this pattern, when I look at the scope of this pattern, that massive divergent high, the breakdown, the powerful drop right there, we break this one, probably get a reaction here. But and that goes, I think, well, this is where I think the dollar could fall to against the yen. And if that happens, that's going to unwind the rest of the carry trade, or at least another big part of it. And what I mean by the carry trade is, if you're not familiar, it's borrowing the cheapest currencies out there, which have been the yen for a while. They've you kept rates artificially low for a long time, and so you can borrow in yen, turn around and game it in the U.S. stock market, throw it in Nvidia, throw it in US Treasury bonds, throw it in just about anything and get a better return, and you profit on that. So that would have an impact on the market. Longer term stuff. This is a weekly chart. But that's that. And then, on gold, okay, I covered the euro, all that, what that's doing. Gold still walking above its uptrend line on the weekly chart. Still has big divergence, but divergence, as I always say, is not a sell signal. What is a sell signal is a break below support. So watch that trend line. It comes here on the daily chart. You can see it right here. That's a little bit busier, but that trend line comes off the February lows right here of this year. It's pretty well defined. You've got this wedge forming. So we keep walking our way up, with divergence, and that warns of a likely correction. What I think is going to happen, you want my 2 cents as to what's going to break this down and cause gold to go down. Right now, everyone wants to buy it. The bid's been strong. We know central banks have been buying it. China's been buying it, individuals. But what I think will happen is when the stock market resumes that next leg down to my longer term price targets, especially once we've broken down below the recent lows, the August 5th lows, and this will break down, and you'll see gold falling as an unwind of the margin trade. Folks that have been loading up on NVIDIA and getting back into the market, those a lot of those people trade on margin. Institutions trade on margin as well. And when things start falling, guess what happens? You get a call from your broker. It's nowadays an email. Back in the day when I started out, you'd have to make a phone call to your clients. But now you get an email and they say, you've got a margin call. You've got, 100 grand in your account. You've got a $10,000 margin call. Either wire us in 10 grand or get it here by tomorrow, however you can, or end of day today, whatever it is. Or if you don't, we're going to sell something for you. And that's what happens. And that's why good things go down in bear markets and people just can't get their heads around it. So one thing to watch for right now, we just broke out. You've had this little trading range here and you broke out to new highs. This is, and let me be clear, 100% bullish. Any breakout to new highs is bullish because nobody is underwater at that time. However, what's very bearish is a breakout to new highs that fails. So watch, we gapped up today. If gold were to gap down anytime soon, if it gapped down tomorrow, we'd have a potential island cluster top with a candle separated by gaps on both sides. Or gold could go up, trade around sideways for a few days, put in a cluster of islands. There's 1,000,001 reversal, candlestick potential reversal patterns. Bearish engulfing candles are one. There's a lot. I'm just saying, keep an eye on that. We gapped up today. The technicals, we have that divergence forming. And we're going to have some volatility with the Fed coming up next week. And just something to watch for. At the end of the day, if you're long gold right now, there's no reason to sell it, but what you'd want to do is put a price alert under that trend line like I just did, and a price alert under 229. I'm going to round it down. I have 229.02. Let's make it an even number. It's really, there's a few little wicks just below that. I could put it there, probably should, about 220. What is that, 228? Something, yeah, about 220.25, but I'm just going to leave it here because I want to be alerted if it goes below 229, and then I'll take a look and see what's happening at the time. Okay, that's good. That's 33 minutes, and I covered two things and then subsets of those two things. I covered treasury bonds as well as the currencies, and that's all related, and then how that relates to gold. So I'll get this video out to you and then start a new one. I would definitely want to cover the stock market today, talk a little bit about the Fed, go over the semis, the financials. There's a lot I'm watching right now. And so I'll get one more video out to you at least today. This has been Randy Finney with Right Side of the Chart. Have a great day.